how to use room in tax thresholds for tax years 2024 or 2025. Perfect examples of how to use the room before you lose it, because the 2017 tax cuts passed by Trump are likely going to sunset or expire. This happens often. And if you don't use the room, you're going to lose it. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist for 5 decades, helping thousands of Americans prepare for a comfortable retirement. And one of my favorite financial vehicles, without question, is a properly structured, max-funded, indexed universal life. Why? Because it's the only instrument in the Internal Revenue Code that allows you to accumulate your money totally income tax-free. Then you can access that money income tax-free. And at the end of the day, when you finally pass away, whatever you leave behind blossoms and transfers income tax-free. And you can structure it to have liquidity, safety, a rate of return averaging 8 to 10% net, cash on cash, so that every $1 million in an IUL can generate $100,000 a year of tax-free income for as long as you live. And then when you ultimately die, it may blossom by as much as double in a death benefit and transfer tax-free. Nothing else does that in the Internal Revenue Code. I've challenged CPAs and tax attorneys that I teach advanced continuing education to for years, and they've yet to show me any other investment vehicle that does that. So let me talk about tax thresholds and why, if you don't use the room in a given tax year, you'll lose it forever. Because most Americans have a tendency, well, if I don't have to pay tax this year, I'm saving tax. No, you're compounding it. You're increasing the tax. You don't save tax by continuing to put it off. That's probably one of the biggest fallacies with most traditional advice. When you ask a CPA, well, how can I avoid paying tax this year? And they myopically say, well, if you're under age 72 or 73 and you don't have to take RMDs, required minimums, then don't take anything out. Well, it's going to continue to defer and compound and increase the tax, okay? They're only looking at that year. If you looked over the long haul, you're not saving tax. You're actually continuing to postpone, delay the inevitable, and increasing the tax. But sometimes Americans have a hard time, well, golly, if I take it out, I'm going to have to pay tax. If I don't, I'm saving tax. Well, you're not saving tax. You're just putting it off. Does that make sense? So let's talk about strategies to use current tax thresholds. So we'll keep this as simple as possible. I'm going to use, first of all, a single tax filer. And I'm going to use the tax year 2024 compared to 2023. There was a 5.4% increase in the amount of money you could earn before you went into the next higher tax bracket. And so generally speaking, the government every year will increase these thresholds by around 5%, okay? And so you could extrapolate from that if you're thinking, I wonder what taxes are going to be for 2025 or 2026 or 2027. They are usually announced towards the end of a tax year for the next year. Well, let's look at this. Let's say that a single tax filer filing a tax return for any taxable income. Taxable income is what you report after all your deductions. You have a line. It differs what line number it is, but it's the one that says taxable income. And you can have taxable income between $47,151 in the year 2024, for example, up to $100,525. That was 5.4% more than the thresholds in the year before, okay? Now that's $53,374 of room. Room for what? Room that you can pay only 22%, which is the lowest tax rate a single filer will probably ever be in after the year 2025. If you don't use the room, you're going to lose it. So you're not saving tax by putting it off. Sometimes that's hard for people to understand. If your taxable income is over $100,000 up to $191,950, you actually have $91,424 of room. So let me make sure I understand this. I was talking about this to one of our dear friends, a widow, who has had money in a 401k rolled over to an IRA. Now, she's been continuing to defer because her advisor told her, you'll save tax if you keep deferring. And then I had to let her know, well, you haven't actually been saving tax. You've been continuing to defer. You haven't had to pay it, but now you're going to have to pay more. But you have an opportunity here. You have a window of time. And I said, so if you have $100,000, and if your taxable income is right around, $47,000 up to $100,000, and let's say her income was $50,000 or thereabouts. Well, she has about $50,000 of room. She has $100,000 in there, so she could get half of it out and pay no more than she'll ever pay in tax, probably the rest of her life, 22%. She's not going to be in a lower bracket. Taxes in the future will likely be higher. In fact, the Trump tax cuts of 2017 expire at the end of 2025, and this 22 will move up to 25. Now, that's not a whole lot of money, but you're going to pay a higher percentage if you don't take the money out, whether you need it or not. Well, she also is reaching the age that she has to take required minimum distributions. So I'm saying you could take the required minimum, and that's based on your life expectancy. But if you have $100,000 and yet to be taxed IRAs, that's only going to be about $5,000 or $6,000. I would take out $50,000. Well, I don't need it. Why would I do that? To get the taxes over and done with at 22%. Instead of waiting and thinking you're saving tax by stringing it out, you're continuing to delay the inevitable and compound it, because after you pay the tax, I'm going to recommend you put it into something that's going to be tax-free from now on. Oh, now there's a lot of CPAs that go, well, what's that? Well, that's a max-funded indexed universal life, and that's where many of our clients have earned average returns of 8 to 10% tax-free net, cash on cash. Any income over $100,000 up to $191,000, there's $91,000 of room that she can pay 24%. Because if she doesn't, after 2025, that's going to jump up to 28. Now, that's not just 4% more. It's 16.66% more money you pay in tax, and I'll show you why. So that's a single tax filer, and so that's called a strategic rollout. You're getting the money rolled out, the tax is over and done with, and then you take the net and put it into something that's going to be tax-free from now on and not have requirements of RMDs. You're getting the taxes over and done with. In max-funded IUL, at the end of the day, when you die, the death benefit reimburses all the tax you paid in almost every case, okay? Let's go to a married couple filing a joint tax return. In 2024, a married couple having a taxable income over $94,000 up to $201,000, that's $106,749 of room between that income and the top that you will pay only 22%. If you have a taxable income between there, let's say $150,000, well, you have $51,000 of room that if you don't use it, you'll lose it. Paying probably the lowest tax rate that you'll ever be in, 22%. You're going to pay at least 25% thereafter, after 2025. If you make over $200,000 as a married couple, up to $383,000, that's $182,849 of room. So if your taxable income is, $250,000, my heavens, you would have, if your income's $250,000, you would have room for $132,000 that you could pay probably the lowest tax rate you'll ever pay on your IRAs or 401ks. I don't care if you need the money or not. Get it out, get the taxes over and done with at today's lower tax rates, and then reposition the after-tax money into an IUL that's tax-free from now on, and that when you die, will reimburse you for the taxes you paid. You're not out anything, okay? Watch the several other episodes to understand, but I'm going to gift you a copy of my book, The Laser Fund, that you can study if this is intriguing you. So this is what I mean. If you don't use the room, you lose it. But it's not just 4% more. So, for example, Donald Trump in 2017, and this has happened several times, Bush and so forth, where they'll pass tax reductions. Bush did it because of the 9/11 terrorist attacks to stimulate the economy. But the act passed in 2017 do what a lot of them do. They expire. They sunset several years later. And so that's due to sunset at the end of 2025. Now, what happens in 2025? The 12% bracket moves to 15. The 22 moves to 25. So if you have room in the 22% bracket and you don't use it, you're going to pay 3% more. But that's not 3% more in money. It's 13.6% more in money. On every $100, if you used to pay $220 in tax and now you pay $250, that's $30 more. Divide 30 into 220. That's 13.6% more money you're going to pay out in tax, okay? The 24% moves up to 28%. That's not just 4%. That's actually 16.66%. That's another $40 on every $1,000. $40 is 16.66% more than $240. That $280 is that much more. So why do you want to wait and pay 16.66% more money in tax when you can get the taxes over and done with sooner than later? So to our friend, I was recommending, hey, even if you move up to a 24% bracket, that's only an extra little amount, but you could actually get half. If you have 100,000 in IRAs, you could get half out in a 22% bracket, at the tail end of 2024, and then January 2nd of 2025. So within a 60 or 90 day window, you can get all your money out of those IRAs, but they're taxed in 2 different tax years. Do you understand that? So you're paying tax of 22%. And you're doing it on a withdrawal at the very end of 2024. So that's taxed in 2024 rates. And then January 2nd, if you pull it out, you're paying tax in 2025 rates. Okay. And it's not due until the next April. But she'll have all her taxes over and done with if she does this within 90 days on 100,000 of IRAs in the lowest tax bracket she will likely ever be in. Okay. Now, if you don't use that room, you're going to lose it. If you wait until after 2025, you're going to be paying 16% or 13% more in money on those accounts that you could have got the taxes over and done with sooner than later. That's called a strategic rollout. Now, I would recommend, if this is intriguing you, that you study examples of this. And there's 2 ways to study it. In my most recent best-selling book, The Laser Fund, that's flying off of our warehouse shelves, you can buy this on Amazon for anywhere from $20 to $60, but I'll give you a copy for free. You simply go to laserfund.com, laserfund.com, or click on the link below and contribute a nominal amount toward the shipping and handling. I require a little bit of skin in the game. I'll cover the rest of that cost, and I'll pay for the book. Now, I'll fire out a hard copy to you via priority mail, and when you're in there claiming your free copy of this 300-page book, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can even schedule to attend a free educational webinar that we do on a weekly basis, no cost or obligation. You can even schedule an appointment to talk to one of the top 13 IUL specialists in America out of 5,000 advisors I've trained. These are the creme de la creme that understand how to do it correctly. You want to make sure it's structured correctly. I would say that over 99% of IUL agents in America do not know how to structure it correctly to do what I talk about on this channel and in my book, okay? So it's crucial it's done right. Now, folks, when you go into the book, it's actually 2 books. This one is the left brain side, and there are chapters in here that talk about strategic rollouts, how to get money out in today's current lower tax rates, and the taxes over and done with, and then reposition the money into something tax-free from then on. This is the left brain side. Now, some people learn by stories. You flip it over to this side, and this has 12 chapters, and one chapter alone has about 5 stories of different people, school teachers, a real estate landlord, a physician and his wife, who was also a physician, a California couple. We took from the highest tax bracket to a 0% tax bracket in 5 years doing this strategic rollout. This simplifies your taxes. It doesn't make them more complex. It gets the taxes over and done with sooner than later. So I strongly recommend that you study either the left brain side or the right brain side. If you want to use your whole brain, you can read both books, okay? But this is one of the most important strategies that if you don't learn it and you don't take advantage before it's too late, you may be kicking yourself for paying 16.66% more money in taxes than you needed to on a big chunk of your income that fits in those thresholds that I talked about.